Good evening, everybody. Hope everybody's having a nice summer evening. Tonight, again, we have the great pleasure of having Stephen Place with us, who does very good setups for option trades. So you probably want to kind of watch this session because he's got some very good good strategies. So with that, Stephen, welcome again to the Candlestick Forum. We're anxious to see your information tonight.
Thank you so much. Good morning, good afternoon, and good evening, wherever you are in the world. My name is Stephen Place. I'm the founder and head trader at investingwithoptions.com, where we teach people just like you how to become great option traders. What's going on, chat? How are you tonight? Hope everyone is doing exceptionally well. I just want to double check if you can see me and hear my screen. Let me know in the chat. That'll also help me figure out what the delay is for this. And I'm going to see if I can crank down the audio really quick. Okay, cool. Right on. I am so excited. This is the second time I've ever done this presentation before. It was very well received with my friends and my clients, and I wanted to share it with you. We are focusing primarily on the kinds of option strategies to consider when you're trading directionally, because I have a sneaking suspicion that most of you here are directional traders. You are not income traders or anything advanced like that. This is on the screen sharing tab right now. So the slides are going to be on the screen sharing tab. And look, this is live video. You know, everything is going to go wrong, but we'll try and power through it as much as I can. No, you can't see me. My camera is turned off. It's just going to be the screen. So tonight we're talking about skyrocket your profits. We're talking about specific option trading strategies and stock setups that you can use to get that next level where you can earn many, many multiples on the risk that you take to grow your portfolio. Tonight we're going to be talking about the option cash flow system that I use. We're going to talk about convexity setups. This is crucially important. Anyone that watched the move in Tesla and Amazon recently must understand what convexity means in the options world, because it is drastically affecting how the markets trade. And if you can identify it and take advantage of it, then you can have some really nice profits. We're going to talk about that mispricing a little bit more. We're going to talk about psychology around convexity setups. We're going to talk about some simple risk management techniques and some trade structures. Every trade structure we talk about today is going to be a miniature case study. So I run a trade service called Income Lab. Income Lab does basically every single options trade under the sun, depending on what we want. We've been doing a lot more directional trading, and they've been working out exceptionally well. At Income Lab, every single trade entry, adjustment, and exit comes with a video that fully explains the trade. So these are not going to be idealized setups. These were put out to my clients in the heat of the battle in real time. So you're going to see how they worked out. And at the very end, if you stick around, we're going to talk about a key indicator that I have adopted and I use a lot to make sure that the trend expansion that I'm expecting is confirmed. And what you'll find, most of these large rallies in large cap stocks, so we're not talking about penny stocks, we're talking about large companies, the strongest rallies will all have this one technical condition. And so you can add this as a little bit of an extra filter to make sure, do you want to be focusing on reversion strategies, or do you want to be focusing on breakout strategies? All right, JV in the chat saying he's got a couple of my things. Welcome, JV. Thanks so much for the kind words. For those of you that don't know me, I am semi-world famous. I'm the head trader at Investing with Options. I've been at this game for 10 years. In the middle of the market crash in 2008, I left my well-paying job as an engineer to go out on my own because I realized I was a terrible employee. And I was pretty good at trading options, and I shared a lot of my ideas, and people started to ask for advice. And so that's how I got started with my website. All right. So this is the cash flow blueprint that I use. And what we can see here is that, oh, hold on. Let's switch it around. What we can see here is that risk flows from top to bottom. Okay. So what you'll find, oh, hold on. There we go. Now, I just did a little trick for you because now your neck is nice and stretched out. We did a little lean to the left. We did a little lean to the right. You should be nice and relaxed. And then we can just focus on this. This is how I trade options. Risk and cash are inversely proportional to one another. The highest risk trades should have the smallest amount of capital, and as you grow those trades, that money should trickle down into less aggressive trades, and then they should trickle down into even less aggressive trades. So we're going to focus on the upper left-hand corner convexity bets. That's what our main focus will be on today, but this just gives you an overall framework. This is part of a book that I wrote, The Independent Wealth Blueprint. Some of these case studies are included in this as well, but the basic idea is that you have very aggressive trades like convexity, leverage like day trading, swing trading, and then the cash flows down to directional income trades like credit spreads, broken wing flies, non-directional income trades, which we're not talking about today. That's much more complex, iron condors, flies, and calendars. And then as those profits accrue, they go into a different bucket, passive assets, like just owning companies, owning debt, owning real estate, and then some long-term ideas, just selling puts, covered calls. Look, it seems like a lot, and to be quite honest, it is. That's why we're just focusing on one single box right here. CB is asking, how long have you offered your service? Just referenced, we're coming up on a decade. So I've been at it for a while now. Rudy's asking, are you in Texas with the other option professionals? No, I was in Texas for about 14 months, and it was flat, hot, and crowded. And we got out of there and moved back to Florida. All right, so convexity bets is where you're looking to skyrocket your returns over 100% relative to total capital, and ideally more relative to total risk, so you can generate larger cash flow in other trades. So a normal cash flow trade, like an income, let's just say an iron condor, you're looking to earn about 10% return on your risk within about a 30-day window, right? It's a very conservative kind of strategy. 10% on $1,000 is not a lot. 10% on $10,000 is much better. So we want to use these convexity trades to help quickly build your account so you can put them into less aggressive trades. So here's the best example I have, and this is what keyed me in saying, hey, there's something wrong with the options market. The options market has completely broken, and it was the massive rally in Tesla where it ran, it had earnings, it gapped up to 650, and then it exploded higher up to 775. Then it had that second push almost all the way up to 950. Okay. Now, I did absolutely nail the short side of this trade, but we're going to focus on the long side as well. See, here's what happens. Let's just focus on this. I'm going to see if I can get a marker, and we want it to be a nice color right here. Let's say you have someone that goes out and they buy a call. All right. Let me know in chat, can you see that box with a C in it? Okay, RB is saying yes, right on. Okay, cool. So let's say you buy a call in Tesla. Well, there's someone else on the other side of the trade that has to take the short call. That's the market maker. Okay, let's say this call has a delta, so net directional exposure of 30. And so the market maker ends up with a short exposure of minus 30. Now, what a market maker does is that they'll either buy the stock or they'll overlay it with some other option positioning, but that's the basic idea. Market makers tend to end up market neutral. All right, now let's say we see a strong move higher in the stock. Well, what happens here is that these options you buy are convex, right? So it's long. I literally wrote the book on option Greeks, but I'm trying not to overcomplicate it. But what happens is the more right you are, the righter you become. It's effectively adding to winners without any additional capital, and that's a beautiful thing. But let's say you see a massive move on Tesla. your position is no longer effectively 30 shares, it's now 60 shares. And so the market maker, which had already zeroed out its original positioning, the market maker has to rebalance again. If you get enough people buying a bunch of call options, you will effectively see an option-fueled convexity squeeze. There were some market makers that absolutely got blown out on Tesla. There were market makers this year that got blown out on Amazon. Okay, and that's just the long side, right? We saw convexity to the downside during the crash in March. But the long side is what we want to focus on because there are distinct opportunities here where the options market becomes a tail that wags the dog. Okay? So there's two kinds of convexity trades that I like to look at. I like to look at continuation trades. These are stocks that are already in an established trend. And then I'm looking at base breakouts and breakdowns. If we want to focus on the short side, we can look at breakdowns as well. But these are stocks that have seen multiple weeks or multiple months of volatility compression and haven't seen a strong move in a while. And the odds are, at some point, the equilibrium in the market is going to break one way or the other, and you will see volatility expansion. So let's take a look at a couple case studies. This first one's in net. This is in Cloudflare. So Cloudflare had broken out. I played it long back here. And then it broke out and it saw a second move, and it hadn't gone anywhere for a while. It went sideways for about a month and a half. I sometimes use the Bollinger Bands to really show when volatility is compressed, right? So this is a key to write down if you are taking notes. Use the Bollinger Bands not for overbought or oversold signals, but to look for volatility compression and expansion. So here's an example. Volatility compression right here, and then it sees vol expansion. And so what happens here is that the Bollinger Bands are really pinching in. The stock hasn't gone anywhere. There hasn't been any strong movement. The odds of a breakout to new highs are very high. So here was the trade setup. This was buying the July 34 calls at 90 cents. Now, the underlying stock was only trading at 30 bucks. And we'll get to why we look at out of the money options in a little bit, but here's something else to write down if you're taking notes. There's nothing wrong with buying out of the money options if your timing's right. So if you can nail the timing, the out-of-the-money options are actually very cheap relative to the actual volatility in the market. We'll take a look at an example in a second. Joseph is asking, are these computer generated? No. I'm not sure exactly what you mean. This is just what I would consider a trade order ticket that I send to my clients that makes it a little bit easier to understand. So I know I'm talking fast because I don't have a lot of time and I got a lot of stuff to get through. But basically what happens here is I use full risk. Because I'm using out of the money options, I don't have a stop. I just use the premium paid on those options. So if it goes sideways or if the stock goes to zero, I'm only out the premium paid. I also like to use out half at a double. Out half at a double simply means that if I sell half at a double, then it is now effectively a risk-free trade, less commissions. So what happens here is that the stock does break out. It clears 30. It runs to 35. The first half is sold at a profit of 100% return on capital. The second half is a boatload more. And then the stock goes sideways some more. I think it broke out a second time. I'm not exactly sure where Cloudflare is trading right now, but it has been a good trader for me. All right, so first half sold. We bought the options at 90 cents. Sold the first half at $1.80, so that's 100% return on capital. Sold the second half at $4.20. That's a 366% return on capital, 12 days in trade. These are very powerful trade setups. These are very powerful trade strategies. You just have to identify the stocks you want to trade. You want to see if they have undergone volatility compression for a while. So you want them to go sideways. And then you want to look for that expansion. There are a couple different ways to view that. You can talk about bull flags. You can talk about cup and handles, traditional technical analysis. You can also look at candlestick patterns. I'm sure many of you know what those are. But that's the basic idea for continuations. Now for base breakouts, it is where there is a stock that has undergone significant accumulation and no more price declines, and we're looking for volatility expansion to the upside. So this one's in Cheat-On. This was actually kind of a cynical play. because we were just looking for these garbage Chinese stocks to start running. There was a strong move in JFIN where a pumper jammed it from something like 3 to 30 in a single day, and we were looking for a second push. Okay, I'm not a long-term believer in this stock, right? This was just a trade. So here's the setup. This is in QD, cheat on. This was buying the Jewel 2 strike call for 20 cents. Again, pretty cheap. The underlying stock was trading at $1.70. $2 is not that far away for a kind of a squeeze. There had been historically some kind of squeeze in the past that tells us that volatility expansion can happen much quicker than what the options are pricing in. Out of the money call options tend to underprice the expected volatility over its time frame. Okay? That means these options are normally cheap relative to the risk you're taking. And again, the stock could go to zero, the stock could go sideways, we could lose all of the money on the trade, but it is a higher odds bet. So again, the Jewels 2 call at 20 cents, full risk, sell half at a triple. We see a move, we see this breakout right here, small pullback, continuation to $3 a share on the underlying stock. I'll tell you what, I did not perfectly exit this trade. Otherwise, it would have been a much better trade because the value of those options went from $2 to $1. Right? So if you put $200 into it and you get $1,000 out, that's $800 in profit off of $200 risk. Here's what you got to understand about options and option pricing. And again, I literally wrote the book on option Greeks. I can tell you how to derive the Black-Scholes model using coin flips. And there's some very advanced stuff, but the basic idea here is that the options market tends to assume that stock price movement will look like this. It'll look like a bell curve, that basically between today and tomorrow, it is an even odds bet that a stock will be up 1% or down 1%. Have you ever seen a stock move like this? It doesn't happen because stocks will trend. And the market, the options market, which assumes a log normal distribution, which assumes a bell curve, is not reflective of reality here. Okay? Manuel's asking, how far in time did you buy it? In this one, let's see. Entry on the cheat on calls was 6/18, so that was June 18th. These were the 17 Jewel 20s, so it was about a 1 month bet. I'm not a huge fan of buying options on weekly options unless you're very exceptional at day trading stocks. All right, you cannot have good weekly options trading without a solid background in short-term trading first. So you got to nail down that short-term trading, and then you can go to shorter duration options. The exit on this was, 3 weeks later or something like that. So here's the thing. There's a lot of option traders out there. There's a lot of option gurus out there. And a lot of people will tell you, you can't make money buying options. They'll tell you things like 80% of all options expire worthless, which is the biggest lie in options trading, period. Because if you have an option that's in the money going to expiration, you're going to close it out. That's just how it works. So of course all these options expire worthless because anything that wasn't worthless is already closed. Okay? So there's a lot of people that say you should only sell options. And I'm a net option seller most of the time. I love doing iron condors, put sales, butterflies, things like that, but I'm here to tell you that you can make money buying options. People say it's a losing game because they're just bad at it. There are a lot of very bad market timers that try and compensate for that by using options to get them more wiggle room. SP over here. Yes, tired of hearing it. I'm tired of hearing it too. I'm tired of listening to these people who say only sell options, except that one time where you get absolutely blown out of the water because the stock crashes, right? There's better ways to do it. Here's another example if you wanted actual evidence. So the Russell Fund, this is something called call overriding. It's where you buy the index and then you sell more calls than what you own. This basically gives us a proxy of how well option selling has worked, and it has sucked. Right, and this shows us just 2020. All right, here's the S&P, which has done well. Here's the overriding fund, which hasn't. This effect has gone back multiple years as well. You can go and you can look at the Chicago Board Options Exchange. The SIBO has a couple benchmark indexes that you can look at and see how well they performed relative to the S&P. Most of the option selling strategies stopped working as well in 2014, 2015 because it became a crowded trade. Remember how everyone and their mother wanted to go buy XIV because it was the only game in town? Everyone just wanted to blindly short volatility. XIV was basically like selling a put over and over and over again. Well, it worked until the fund got blown out. Okay, so it is useful as an options trader when you consider a portfolio of trading strategies. It is useful to have some kinds of convexity bets. Here's a recent example, and this was from last week, I think. Facebook was trading at 250 on Thursday. It traded up to 265. Nice earnings breakout, pulled back, had a monster move. Even before the earnings event, the average true range was $8. So Facebook was moving $8 a day. Okay, so $8 off of 265. I'm not good at doing math in my head while I'm talking, but it's 270 something. So if we look at the 275 call, the implied odds with 1 day to go is 10%. Rubbish, right? It's so underpriced. The odds that Facebook, with an average daily range of $8, either to the upside or downside, the odds that it would be 10% are hilariously low. Now, what happened here? Facebook, if you go and you look at how it traded last week, it actually jammed into 275. Okay? Because that's how these stocks are moving. There's a lot of volatility, and options are not super expensive. There's a lot of people trying to make coin by selling weekly options and pushing those premiums down that it skews the market so much. Here's another example. This was a position I had on in Las Vegas Sands. I'm out, but here's an example. This is from last week. Las Vegas Sands trading at $46. It held support pretty well. Here's the September. So these had a month and 2 weeks left. The September expiration calls on the 50 strike. And you say, oh man, 50 is really far away. You look at this and you say, man, the odds were pretty low that were being priced in on Las Vegas Sands calls in September options. And you don't need to move to $50 to make money. You just need to move to maybe $48.80, $48.90. All of a sudden, that's 100% gain. And then you can sell half at a double and you can see if you can get a decent move. All right, so those are the kinds of opportunities available for you. How much time? Okay, I'm going to go through these really quick. Psychology of convexity. You got to embrace risk. You have to be willing to lose all of your money. If you're buying out of the money calls or out of the money puts or out of the money put calendars, things like that, you can have a stop, but it's usually useful to have smaller position sizing and don't run a stop. Because if you're right, your directional exposure is going to increase. Right? If you have a net delta of 200 and then the stock rallies hard, you're going to have a net delta of 300. Right? So you don't have to have a whole lot of capital available. You just have to be willing to lose it all. All right? That should affect your position sizing. Don't bet the house on a single trade. You don't know if the trade's going to work out. As soon as you put that in your mind, it becomes a lot easier to think about these. You stop worrying about it so much. I have clients come to me and they're like, oh, what's going to happen with this trade? I'll usually say, I have no idea. Right? The trade setup's there. If it works, it works. If it doesn't, it doesn't. You don't know how far a winner will go. There are some trades that if you ride the trend long enough, they can make your month, they can make your year, they can make your career. Right? What would we give to go back to 2019 to play Tesla calls in that run? Right? If you knew that was going to happen, multiple millions, just straight up right there. So you have to find ways to manage your risk, to roll your option positions, to spread your option positions, to try ride a trend as much as you can. And what I like to do, understanding other trader psychology will get you a massive edge. All right, it's not just about lines on a screen. When you look at a stock with technical analysis, you need to ask yourself, where are people going to get screwed? Where are they going to get stopped out? Where are they going to have the fear of missing out? When are they going to get squeezed? That's how I continuously think about the markets. It's not about blindly accepting trading indicators or anything like that. It's understanding the motivations of the other players at the table instead of looking at just the cards on the table. Okay? So here's an example of not knowing where it's going to go, right? AIG doesn't look too hot right now. But it did for a hot second right here. It broke above a trend line. The pricing for the out-of-the-money calls were very low. So this was the trade setup. This was all the way back in June. This is the end of June. This is buying the August 37 call at 41 cents. Same kind of structure, full risk out, half at a double. Well, AIG moved. We're able to get it out at a double on this push right here, but then it absolutely collapses on earnings. All right, so it's going to be a break-even trade. Right? It's not going to be a loss other than commissions paid. Right? It's just going to be an okay trade. Now, something might change between now and August expiration, which is next week. You know, we might get something. We might get some kind of a breakout, or it just goes sideways for a while. Again, we just don't know. We don't know the outcome. We just have to be positioned at the right place at the right time to quickly exit out of half so we don't have to think about losing money. Here's another one, AMD. This is June 23rd. These are buying the August expiration calls. This is the 60 calls. At the time, AMD was trading at 54.5. Well, we all know what AMD did, right? The August 60 calls at 273. There's a stop out half at 546. So out half at a double relative to the cost. I don't have a chart of AMD. AMD's trading at 80. Now, did we run it from 273 to 20 bucks? No, we did some adjustments where when we saw that big move on AMD before its earnings event, we rolled the calls up higher and held the rest through earnings. And then we got that second push on earnings and then a continuation. And we did some adjusting, and it's a really nice trade. It worked out exceptionally well. Currently, we've got the AugSep 80 calendars on. So ideally, we get a pin of 80. But again, you know, 273, it was absolute max risk. Planned risk was something around $150 a contract. We already got half at a double into the push to 70. We rolled up to the 70 calls, and then we saw a push into 80. We rolled up to the 80 calls, converted it to a calendar. Barbara's asking, why not buy a put on AIG? AIG is not, for me, and it may not be for you, but for me, it does not have a clear bearish setup where I'm expecting risk volatility expansion. The chart of AIG looks a little bit different like right now, but the problem with, for example, buying puts straight up is you've got this support level. So what happens is that if it comes to support level and then bounces, right, you not only lose some of your profits from the bounce, you also lose some more profits from the time decay. You also lose more exposure to the trade because of the delta decay. So there are other things going on. But since you asked, here was a play in Wells Fargo to the downside, right? So if you turn this upside down, this would look like a breakout to all-time highs, right? But it's a short setup. So the trade here, very simple idea again. This was, I don't have the entry right here, but it was the June 25 puts looking for the breakdown. We sold half, pretty much at a double, maybe a little bit more. And then we converted it to a spread. We converted it to a bear put spread. Now what happens here? You know, Wells Fargo didn't fall out of bed. I thought the sucker was going to the teens. I thought it was going to go to 17. And it didn't happen. The breakdown failed. And so we had to cut the trade out. All right. Jake's asking, what percentage of trades that you take recommend do you break even, win, or lose? So I've done very well this year, and I'm not going to jinx it. Right? So I'm not going to talk about win rates because we've done really well. I'm not going to talk about how the magnitude we've done, because as soon as I do, the market gods will descend upon me and show me how dumb I am. All right, so I've been on a hot streak, and I'll just go ahead and say it right now. My read on the market can change, and that's always possible. All right, so we'll just keep it at that. SP is asking, do you only look at a few stocks with higher volatility in ATR? Well, SP, what I look for first is options liquidity, right? If I'm looking to trade options, there must be an options market, all right? So I generally look for stocks with an ATR above 1. I generally look at stocks at a share price above $30, all right? Let's see. DDC's, why is your record a secret? Really? It's not. I just don't have the spreadsheet up. That's all. I'm not even talking about the trade service right now. I'm just showing you case studies, hopefully. Some other trade structures to consider. All right, so we talked about long calls, long puts. When you think about stocks like Amazon, when you think about stocks like Tesla or Priceline, which is now booking, they can become very expensive on an absolute basis, right? You don't want to go to Tesla right now, which is trading around, what, 1,400, and you buy 1,400 call, and the call buy is going to be the same cost as a car. So there are other things you can do that are a little bit cheaper on an absolute basis. So here's some examples. The first one's in DocuSign. DocuSign was kind of a theme play where we were looking for a push and a breakout. This was back in April when the market still looked awful, right? And DocuSign was trading near highs because it's a COVID proxy play. So the trade setup here, I thought that the options were a touch expensive. So the setup here was the May 95-105 bull call spread for $2, right? Same kind of thing. Full risk out half at 4. Now we saw a move, right? And what happened here is that we converted the trade from what was it originally? The 95-105 up to the 105 call calendar. Now what that does, when you convert a trade like that, what'll happen is that the stock will move significantly past your short strike. So that's what happened here. We saw a move where DocuSign had a nice push, and then it ran up to about 103 right here, and then we converted the trade to a calendar. And when you do that, you actually get net short as we see a push to 107. And that's what happened. The stock just jammed to 121. Again, we don't know how far these things can run. We have no idea. And so it is useful, unless there is a change in the trend, to make sure that you don't get super aggressive net short. So this trade worked out, but it didn't work out as amazingly as it could have because the upside was limited. Here was another example. So I was expecting Tesla back in February to start making a move. Tesla options at the time were pretty stinking expensive, but I was looking for a moonshot bet here. I was looking for a push to 1,200. So the trade setup here, this is a little bit more advanced, but this is another example of a different kind of trade structure you can take. This is the July 1040, 1200, 1360 call fly. And this was partially financed by a bear call spread on shorter term options. Now, if you just felt like you got thrown off the deep end, yes, you did. You got thrown off the deep end. This is a very advanced trade. And the trade worked out well. And what happened here, all right, so we're going to talk about this indicator in just a second. But what happened, I mean, we all saw what happened in Tesla, right? It eventually made it to 1,200, and then it just kept pushing and pushing and pushing all the way up to 1,500. And so this is what the trade ended up looking like because, again, it was super advanced, and we adjusted and added some other things to help reduce the risk on the trade, and it was a monster winner. But again, you just got to respect that upside because we ended up at something like 1,450, 1,500, and a lot of these profits were lost. Again, still a nice trade. We just don't know how far these things are going to go. Gary B in the chat saying fly is a butterfly. Yeah, so a butterfly spread. Marshall's asking what keeps you in the trade when it's running for the straight out of the money trades. Ideally, what happens is that, let's just say you buy some out of the money calls and then you see a move. And then what you can do is you can roll up the trade. So let's say you buy a 50 strike call option and then the stock moves from 50 to 60. And then you can close out that 50 option and then open the 60 option, the 60 call option. That'll take some more cash off the table and still leave you long some. And then what happens if the stock goes sideways or pulls back, that 60 option could expire worthless. Or again, you just don't know how far these suckers can run. Okay. Now I'm saying this all right now in the context of the S&P 500 rallying and rallying and rallying and coming into February levels, pre-COVID crisis levels. I'm saying this after semiconductors have already seen a massive run. I said this after all of these software names saw massive runs, had amazing earnings, but are still getting hit. Okay, so it may be time for some consolidation in some of these names where you just have to be prepared for if they decide to see that second push, right? Then you can take advantage of it. Here's another one. This was recent. This was 2 weeks ago. This is an NVIDIA. This was the, again, a butterfly spread. The 435, 450, 465 call butterfly. These are what I call time bomb butterflies. You can also call them lotto tickets because that's what they basically are, where, you know, expect to lose all your money on these. These are low odds trades. They don't, statistically, they don't pay out as often, but when they do pay out, they pay out exceptionally well. And that's what happened on NVIDIA. We were looking for this breakout right here, and then the measured move off of this level was to 450. NVIDIA had gone sideways while the entire time AMD was running higher, and NVIDIA had earnings coming up. So I was expecting a pre-earnings run, and that's what we got. So the original entry on this call fly was $1.30, sold half at 134% return on capital, sold the other at 650, so that's 400% return on capital. So again, it's a lotto ticket trade, but when it pays out well. So those are the kinds of structures you can take. And I know a lot of you are directional traders and probably have some very good systems for timing stocks already. There's just some other options, if you'll pardon the terrible pun. There's some options available for you out there in options land. You can look at buying out of the money calls. And again, I think that they are a better bet compared to buying at the money or compared to buying in the money, simply because you get that convexity. If you're looking at more expensive trades, you can look at call spreads, you can look at call butterflies, you can look at calendars, things like that. Here's one. This one for me is live, so we'll see how it goes basically tomorrow. Overstock was at $5 in March. It's currently around, at the time of the screenshot, it was around 90. Right now, the stock's, it ran to 100. It's trading at $90 right now, so we'll see how it goes. If you want to look at bearish opportunities, and I think that there are some really starting to show up, some bearish opportunities where you look at put calendars. And there's some more advanced reasons for that regarding implied volatility and term structure and some witchcraft. But what these are so nice is that they don't have a whole lot of directional exposure initially. And what tends to happen is that these short options, they'll expire worthless, and you can either convert the trade or you can just leave it on with a very cheap put. Okay, that's basically what happens with these calendars. So right now, this isn't the full trade. I've actually got the 85 strike on, so it's a 75-85 double calendar. So let's all hope and cheer for Overstock to go to 85 this Friday. We'll see how it goes. Deborah's asking, do you trade weekly options as your main time frame or generally a month or two out? I go longer dated options. I like having a little bit more time because these out of the money options are pretty cheap relative to the actual volatility in the underlying stock. You can buy some time and it works out pretty well. For the short side, puts are kind of expensive right now, right? Here's something wild. The VIX is it's around 22, 24. And we can compare that to the actual volatility in the market. The actual volatility in the market is something around 9. So there's a massive premium right now in index puts. There's a massive premium in a lot of individual stock puts. And that kind of makes it really hard to trade to the short side right now. So there's some things you can look at. I think calendars are a good setup. We've been selling ratios, which is another advanced trade on some of these stocks that have just gone bonkers to the upside. Okay. Jake's asking, what's the over-under calendar on Overstock? So this graph, the y-axis is profit. The x-axis is the underlying price. Okay, this blue line is my P&L curve as we come into basically tomorrow. And look, if Overstock runs tomorrow, because it's kind of a Bitcoin proxy play right now, if Overstock runs, then I'll just be left with the August expiration 75 and 85 put, and I can do some other things with it where I can convert it to some other trades and things like that. Okay. MP's asking, what are the triggers for your stock selection? I'm either looking for recent volatility expansion or I'm looking for sustained volatility compression where I'm looking for strong moves. Okay. Nisa is asking, is there a guideline used for the bid-ask spreads in the options chain? If you can drive a bus through the bid-ask spread, I'm not trading it. All right. So that's about as simple as I can get it. I'm sure there is a mathematical formula I can use, but I tend to look at the same stocks over and over. I look at the most traded, most volume stocks, things like Apple and Amazon and Facebook and Exxon and Bank of America, things like that, and they're going to already have pretty liquid options. Rudy's asking, the reason for the question earlier sounded like a student of John Carter. No, I know John, and John's very good. I did see that Tesla trade. It wasn't even the Tesla trade in 2019. The Tesla trade he took was actually a earnings got released during the trading day in Tesla, and I think that was 2013. It was pretty wild. Jake's asking, can you tell us what you've bought and sold on Overstock? All right, so this trade, this is long, the August monthly, so they expire in 2 weeks, 85 put and 75 put. And then I have shorts in the options that expire this week in the 75 and 85 put. So I'm bearish. I want Overstock. I don't want it to go to zero. I want it to have a pullback. Ideally, somewhere between 75 and 85, basically by tomorrow. If it doesn't happen, then I can do some other things where I'm still betting on a pullback, but my aggression starts to increase, right? Again, we're jumping off the deep end tonight, right? We're looking at super advanced trades just to show you the opportunities out there for you, all right? So this is, we looked at normal call buys and maybe some put buys and things like that, but then you can start looking at some other spreads that can get you better returns relative to the risk that you're taking, okay? One more thing, the indicator that shows when stocks are ready to explode higher. So what happened back in 2019? I saw that move in Tesla and I'm thinking, I said some other naughty words first, but I said, what does the rally in Tesla and other massive moves in liquid high beta stocks, what do they all have in common? And can we identify when they start moving before they really start to move? So here we go, drum roll. This indicator is an ADX with a smoothing curve on it. All right, so this is it's a custom indicator. It's really easy to build out. You just have the ADX and then you add a moving average onto it. So what this shows you, the ADX basically shows us how well the stock is trending or not trending. So it doesn't care about the direction of the trend. So in a hard sell-off, the ADX will be high. In a hard rally, the ADX will be high. If the stock is chopping around and doing nothing, the ADX will be low. So what we want to look for are crossovers between the moving average and the ADX. And what you will find, I mean, go look at some of the most recent runs over the past 5 years in your favorite stocks, and not penny stocks, not super low float names. I'm talking about very liquid stocks. Odds are you're going to have this trigger before the big move starts. You're going to have this trigger before the big move starts. So I'm using, I'm pretty sure I've got this right. It's a 20-day ADX, and then the moving average is 50. Or it's the other way around. I will add that to the slide notes later, but I can share the code for anyone that wants it as well. It's again, it's just a out of the box ADX with a moving average, just to give you an idea of when the trend is about to show up again. Okay. Will's asking you, so you don't use the DMI with the ADX? I mean, it might be the same thing, but no, I don't. I just look at the ADX, and then I add a moving average to show when the ADX is about to shift. Does this ADX crossover absolutely nail when a stock is going to move? No. Sometimes it will show up after the stock has already moved, but you can take advantage of trend continuations as well. Okay? So one thing you got to understand, and we'll end with this, is that you're only as good as the stocks you trade, right? If the S&P is within spitting distance of all-time highs, the NASDAQ 100 already hit all-time highs. If you look at the equal weight S&P, the average performance is nowhere close, right? So there are a lot of people, unless you were in the right kinds of stocks, you've underperformed. If you bought energy stocks, you're still underwater, right? If you bought bank stocks, they haven't gone anywhere. You need to make sure that if you're going to trade momentum and you're going to trade directionality, that you focus on the select few that are the momentum darlings at the time. They will not always be like that, but that list will continue to shift as well. So here's what I want to offer you today, because I could keep going on and on and on about this, but we have limited time. So we're going to do another class. This is the waterfront stock trading class. And the idea is when you have an absolute crisis in the markets or the markets aren't doing very well, there are a select few stocks, very similar to waterfront properties, that don't lose the value in a recession. You have to find these stocks because they will give you the best trend continuation setups. So this is going to be a live class on this Saturday. This will be recorded. For those of you who can't make it, it's going to be at noon my time. So it's going to be over lunch this upcoming Saturday. It's going to show you how to scan for the biggest winners, when to find the next entry point, and a key trigger that I like to use to buy calls. And this trigger is not available on a lot of trading platforms unless you add it in. Some of the newer trading platforms already have it, but we will be looking at a trigger, how to buy those calls and what kinds of calls to buy. You'll also get the watch list included in this. You'll also get a hit list of some of these stocks that I think are actually going to start going lower. As a reference, the last hit list I put out on Sunday, NVAX was at the top of the list, and you can see how well that's done. So you get the watch list. You also get my PDF on foolproof option buying. So we'll talk about how to be precisely consistent with how you manage your risk and the options that you choose to buy no matter what stock you're trading. Because Apple options are not going to behave the same as ExxonMobil options, and Exxon options are not going to behave the same as Bank of America options. The underlying volatility is different. Okay. You'll also get a white paper that I wrote called Taking Over the Internet. And this is about a company that is basically going to own a full layer of the internet. All my websites have the technology on it. All the other websites that I know of are starting to build out that technology. and the company has just gone gangbusters, and I think it will continue. So it's just $47. So this is a get to know you class where you can come and get to know me and see my approach and see how I trade things. This class today should show you that pretty well. You also have to understand that I am not a directional trader most of the time. I also have income trades like iron condors and things like that. They're a little bit less aggressive and more conservative, but still have very good expectancy curves, which is nice. So a single payment of $47. You can get access to it at investingwithoptions.com/waterfront. Man, I hope that's the right. I think that's right. That should take you there. If you're in the chat, I just typed it in. That'll take you to the page that explains a little bit more what we're going to be talking about. At the bottom of that page is going to be a button. Click the button. It'll take you to the secure order form. It's $47. Once you order, you'll automatically be added to the webinar on Saturday, and it's going to be through Zoom. I'm bearish on Zoom right now, but I still use the tech. Jake's asking, what do you mean by a layer of the internet? So you have different layers. The internet's like an onion, right? You have the physical layer, you got Ethernet, you've got TCP/IP, you've got all these, the DNS layer and things like that. And there's one company that's going to own an entire slice across all web properties. Okay. Yes, the OSI model. So I actually, in the paper, I talk about the OSI model. I probably butcher it a little bit, but that should give you an idea. The internet's like ogres. This is going to be 12 noon Eastern. This is going to be this Saturday. It will be recorded, so if you do want a recording, you'll get access to that. I've also done this live class in the past, so you can see all the other trade setups we looked at about a month and a half ago, and you're going to see how all those did exceptionally well too. So yeah, $47 to get access to the live classes, investingwithoptions.com/waterfront. That'll take you to the page that explains what we're going to cover. You can then click on the button at the bottom, and it'll take you to the secure order form. Fill out your information. You'll get access to the members area where you can, if you want, watch the last recording we did so you can be prepared for it. They'll have all your bonuses there, and then you'll automatically be registered for the Saturday class. I hope we got all the integration set up right, but it should be good to go. We did run tests on that, and then I'll see you all this Saturday at noon. Tony's asking how long is the class? It's about an hour, depending on how many questions we get. Samita is asking, is the class for beginners? Yes. And it's not even an options class, really. We do touch on options, but we're also going to talk about specifically what kind of trend continuation strategies to look at. Cool? RB saying the link did work. Right on. Any more questions about anything else that we talked about today? And I just want to tell you, it is a real treat to come into Steve's chat room. You all are always the best. I do webinars every once in a while in some other places, and they're always boring. You guys are exciting. You ask a lot of questions, and I really thank you for that. Jake's asking, sounds like your class will be a TTM squeeze type of thing. It's not TTM squeeze, and I know what you're talking about, but it's not that. It's basically, if you know what the squeeze is, we're looking for the second move after the squeeze. All right, so it's going to be a continuation trade. Jim's asking 12 Eastern. I'm pretty sure it's 12 Central. But you'll find out when you get the emails and everything else. SP saying, sound like mid-level option learners can benefit too. Yes, and again, this is a get to know you class. You get to know me if you like me, and if you like my ideas, you're going to go down the rabbit hole. And you know, we've got a bunch of other products. We've got some trade services as well, if you're interested in that. Yeah, it's cool. All right. I think that's it. If there aren't any other questions, I am out of here. Anything else?
Steve, very good stuff. Everybody take a look at it. Here's another a very high probability perspective of how to make money with options. Steve illustrates that very well. So Steve, thank you very much for the information tonight. That was great stuff.
Pleasure.
So with that, everybody, have a good evening. We'll see you in the chat rooms. We'll see you then.